What can go wrong with IUL? What is the downside? By the end of this video episode, you will understand the various reasons that can cause an IUL to not perform optimally and what you can do to prevent those problems. But you'll understand that sometimes maybe it's choosing the wrong company or wrong product, but I think you're going to be surprised that many times it's because the advisor is not proficient. So I'm going to give you some criteria and rules in this episode so that you can determine if an advisor knows what they're doing. So I'm Doug Andrew. I've been doing this for more than 48 years, helping people optimize their assets, minimize taxes, empowering their authentic wealth for long-term goals, oftentimes like retirement. And if you've watched very many of my educational videos, I'm very passionate about a particular product that I think retirees in particular ought to have 40 to 60% of their assets in at retirement. In other words, that 40 to 60% of their retirement income, I think, ought to be totally tax-free, not even showing up on the front page of their 1040 tax return. Because so many retirees approach retirement and they're way too top-heavy in yet-to-be-taxed IRAs and 401ks in the market. And I go, what are you thinking? And the rest of their retirement, they're taking money out of those IRAs or 401ks and paying tax the rest of their life, and they end up paying back 8 to 12 times the taxes during retirement than what they saved on the contribution and on their deposits into IRAs and 401ks. They're usually not in lower tax brackets if they save very much money. So in this episode, I'm going to talk about, so if you think an IUL policy might be right for you to accumulate your money tax-free and maybe reposition some of that money out of those IRAs and 401ks into these, which many people do, to increase the liquidity, safety, and rate of return and the tax benefits. And so you want to reposition that, or maybe money in underperforming or non-performing assets like money in a bank or credit union, or maybe you're tired of being a landlord, you want to sell a property and take that real estate equity and put it into one of these or a portfolio of these. Any lump sums, settlements, I call an IUL policy the financial Swiss Army knife. You can use it as a dream solution for many financial goals. Because frankly, in the Internal Revenue Code, very few vehicles, in fact, I know of no other vehicles that actually allow you to accumulate your money totally tax-free and then be able to access that money tax-free. You don't have to wait till you're 59 and a half. There's no rules or whatever. I've had people put in $200,000 and pull out $120,000 4 days later. Tax-free, no penalty. You have flexibility. You access your money tax-free. And at the end of the day, when you die, anything you leave behind blossoms, increases in value, and transfers tax-free. I don't know of anything else in the Internal Revenue Code that allows you to do that. But then people go, okay, this sounds too good to be true. You probably heard people say, well, if it sounds too good to be true, it probably isn't true. Well, I often retort and say, well, if what you always thought to be true turned out not to be true, when would you want to know? Or let's flip it. What if what you always thought not to be true turned out to be true? See, a lot of times people are told, life insurance? I've never seen life insurance be good as an investment. Well, actually, we do not call it an investment. An investment, according to the Internal Revenue Code, will sooner or later trigger tax. I don't want to pay tax anytime. That's why I use IUL. Also, most investments are subject to volatility. I don't want that. So an IUL policy is not an investment. I don't want one of those. And some people say, well, how come I've never heard about this? Well, I'll address that in another episode. But people say, well, come on, what's the downside? I'm going to be totally honest with you. I'm going to share with you the downside. And I'll do it probably in order, but the last reason is probably the most common reason why IUL policies do not perform as good as they could have performed. So let's start out with some of the basic reasons why maybe they do not perform at an optimal level or what have you. Sometimes people just flat out choose the wrong insurance company. There's probably 2,000 to 3,000, legal reserve insurance companies in the United States. A legal reserve insurance company just means they have to have reserve requirements on hand that are liquid and safe in case of a run on the banks in America, because this is where a lot of banks and credit unions put your money in the bank in insurance companies in case of a collapse because they want liquidity and safety. So banks actually put your money, a lot of your money, into insurance companies for liquidity, safety, and rate of return. If this is where they're putting their money, you want to make sure you choose the right company. So there are rating agencies out there, S&P and AM Best and Duff & Phelps and Moody's and Fitch and Weiss and all these. It's a little bit complicated, and so they actually assign a Comdex score where they take all of these analysts and they combine them together. And I would recommend, if you're choosing an insurance company to put serious cash into, money you don't want to jeopardize, that you choose a company that is rated, 85, 90 or higher with their Comdex score. So if you chose a company that was rated 92, it just means that company is rated stronger, safer than 92% of other companies in existence in America. So you want to choose the right company. I would say out of a couple of hundred insurance companies that offer indexed universal life, because not all of them do. A lot of them don't understand how to do it and what have you. It's not their forte. They only sell life insurance for death benefit. They talk about we're big and we want to be here when you die. So they think that bigger is better. Now, I've always said, well, if bigger were better, Miss America would be an elephant, right? Okay? No, just because an insurance company is bigger doesn't mean it's better, because maybe they're more stingy. Maybe they keep all their money in their coffers and they don't pay you good rates of return or dividends. So you don't measure based upon their size. You want to see which ones are generous. I usually am more partial towards a mutual company because they're more generous than a stockholder company because they're beholden to stockholders. So you want to choose the right company. And I would say out of maybe 200 that offer IUL, I would only put my money in only a half a dozen of them. And so many of the advisors that I teach, they know which companies I put my money into because I'm very, very picky. So when you do the math, only the top 2% of insurance companies would I put my money into. Now, once you understand those, you can diversify between those 3, 4, 5, or 6 companies. That may be overkill. You could just choose 2 of those companies or 3 of those companies. Now, I also diversify by putting some on myself, some on my wife, some on my kids. So I diversify by doing that, but I also diversify by using different indices and linking methods, which I cover in other episodes. But when we talk about the downside, if you choose the wrong company right off the bat, maybe you will not get a good rate of return because the company didn't really design the product. So that brings us to the next one. If you choose the wrong product, maybe you chose the right company, so to speak, but you chose the wrong product with that company. Many companies have various products. Now, to be honest with you, sometimes insurance agents will sell you the product, the policy, that almost benefits their wife and kids more than your wife and kids. I hate to say that, but you want to make sure you choose the right product based upon your goals. So the right company and the right product. So far, so good. So what comes next? Well, when you structure an IUL policy, and by the way, if this is beginning to resonate with you, you ought to share this with other people that would benefit from this education and post a comment. Okay, but I'm going to show you at the end how you can go talk to a professional and see if they know how to do it correctly. Because the next critical issue is make sure that it's structured correctly. Unfortunately, I would say that over 99% of IUL policies in America are not structured correctly or funded properly. Now, to structure it correctly, you've got to understand under TEFRA, DEFRA, and TAMRA tax citations and under sections 72E, 7702, and 101A of the Internal Revenue Code to structure the IUL policy based upon what you're planning to use it for and how soon you're going to start accessing money, okay? So you design it to accommodate only the amount of money that you will likely put into it, and you take the least amount of insurance that you can get away with under those IRS rules, and you put in the most money as fast as the IRS allows. You wouldn't believe how many insurance agents don't know how to do that. They don't know how to squeeze down the death benefit, even if you get rated to where if you earn 11, you net 10. So let me just cut to the chase. If an advisor does not structure it correctly, instead of earning 11 and netting 10, you might earn 11 and only net 6. In other words, there's a whole bunch of expense in there that was unnecessary And so you're not going to achieve the optimal net internal rate of return if your goal was living benefits. And I all too often see these mistakes being made. And it's very sad when I look at the policy and I go, who designed this for you? And people go, well, we read your book, Mr. Andrew, but, we asked our nephew because he has an insurance license and he said, sure, I'll do that for you. Or a brother-in-law. I go, wow. That was an expensive relationship. You know what? You started this out with $500,000. You should have $1 million in it today, and you only have $250,000. How come you lost half your money? You should have doubled your money. And I look at it, and in 30 seconds, I go, who designed this? Your nephew? Your nephew cost you $750,000. You don't just choose somebody because they have an insurance license, even if they say, I can do that for you. You want to make sure that they understand certain questions that I'll give you here at the end of this episode, okay? So you want to structure it properly, and then the other part is on you. You need to fund it properly. If you say you're going to put in, $500 a month, you better put in $500 a month or make adjustments if you can't afford that. If you are going to put in $100,000 a year and you don't, you either need to make up for it sooner than later, or you need to adjust it. If you don't, it will not perform as illustrated if you're not funding it properly. So it has to be structured correctly, but it has to be funded properly. Now, you're not locked into anything. It's very flexible. If you've listened to very many of my episodes, I have a beatitude. Blessed are the flexible, for they shall not be bent out of shape. I don't want you to get bent out of shape. And so when you have flexibility, if you come in for an annual review with a licensed advisor, they'll find out, do you have more assets, more resources, or things, are you hurting right now? Did you lose your job or whatever? And we need to make adjustments. You can do that and still make it perform optimally. But if you don't, if that advisor is off doing something else now and you're left to yourself, you better have somebody who knows how to keep it current, or else you will end up maybe earning 10 and netting 4. I want you to earn 10 and net 9. I want you to earn within 1% of the gross rate of return. That 1% is the cost of the insurance. You want that cost of insurance to be as low as possible. Is this making sense? So let's review so far before I get to the last one. So you want to choose the right company. You want to choose the right product. We're down to a very small percent out there, in my opinion, but it has to be structured correctly and then funded properly by you. And so when you have annual reviews to be accountable, I always had my clients come in and I wanted to be accountable to them and I wanted them to be accountable to themselves or to me and make adjustments so that we could stay on track. I usually use the metaphor of this. If you were going to get in a plane and fly around Earth 26,000 miles and you were 1 degree off course and you never corrected that, you would be 500-600 miles away from where you were going to end up if you didn't correct a 1 degree deviation. You must stay on track. That's the importance of having an IUL specialist that you meet with regularly to get you back on track. I don't want you to miss the goal of having the maximum amount of money at the end of the day that you could have. To be honest, the biggest reason why most IUL policies do not perform as illustrated or as represented is because the advisor is not proficient. And you can't tell that unless you know what questions to ask the advisor. This is why, after training 3,000 advisors, I had, based on my publisher, Time Warner, they said there was at least 50,000 advisors buying my first book, Missed Fortune, in bulk, in cases of 20, passing them out like loose cannons, but they were buggering things up because they were not doing it correctly. And so I began to develop a training, and professionals who wanted to learn how to do it correctly would pay $6,000 to come through and learn. And I had 3,000 advisors do that. Then 2008 hit, and some of those advisors' clients would call us and say, what happened? My policy, blah, blah. And I go, oh my heavens, well, where's your advisor? Well, they left. Really? So then I developed a proficiency exam. It's not an easy exam. It has 100 questions plus 30 essay. It's not an easy exam. In fact, most advisors you hear on radio and TV, if they took that exam, even though they are a certified financial planner, they wouldn't even score 30% on this exam because they wouldn't understand 70% of the questions. I've seen this. If you understand how to structure it correctly and fund it properly and you do annual reviews, you can stay on track. So this is what motivated me in my most recent best-selling book, The Laser Fund, to put a chapter in here about how you can correct something so that you do not end up missing out. And so in this chapter, it's titled, What Can Go Wrong and How to Improve It. And on page 195 of this book, and by the way, if you don't have a free copy of this, hang on, I'm going to show you how you can claim your free copy. But in here, I call it the Laser Ready Test. And there are several bullet points. And if you ask these questions of an advisor, off the cuff, don't warn them, just come in and say, I have some questions. What is tephra, tamra? Okay? If they can't answer that off the cuff, that's a red flag. Okay? Explain Internal Revenue Code sections 72E, 7702, and 101A. If they can't answer that off the cuff, something's wrong. Then you go on down and you start asking them the rest of the questions here. I have an entire page and into the next page of bullet points. And if they can't answer any of those pretty much off the cuff, if they go, I don't know, I'll have to check it out, or if they go, I think, or if they're making up an answer and you can tell it, that's a red flag. That's why I put them in this book. Because any advisor who understands how to do it correctly will know the answers to every single one of those questions on page 195. So this is about you. I want to protect you. And so when people say, what's the downside? What can go wrong? Well, this. But mainly, if you choose the wrong company, if you choose the wrong product, but if you choose the wrong advisor, good luck. Because that's the biggest reason, and I would hate to look at your IUL policy after you've owned it for 5 or 10 years and go, oh dear, who designed this for you? And if you told me it was, your nephew or a brother-in-law, I'm going to go, ugh. We've got to make up for all that lost time, and I don't want to have to do that. So claim your free copy of Laser Fund. That's the first step. Make sure you're studying this and watching these episodes. You go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book and fire it out. This has charts, graphs, explanations, and 62 actual client stories. And when you're in there, you have the opportunity to actually schedule an appointment with an IUL specialist that I oversee, that I know has passed that proficiency exam and has to continue to pass quizzes and exams all the time to stay fresh and current. So I can point you to the right people. But here is to your brighter future doing it the right way.